Okay, well, it seems like tech is taking center stage as Magnificent Seven companies start to report results. Is that going to create fresh momentum for Silicon Valley players? Alphabet shares moving higher today after the company's latest quarterly results. For some more perspective on the mood of the markets and these latest earnings from the tech giant, we're joined by Martin Cobb. He's a senior vice president of Equities at Lorne Steinberg Wealth Management. Martin, it's great to have you with us. You know, I think that Alphabet is this great example of a company that's had a lot of things on the go, and investors had arguably, I know the stock had been moving higher off the April lows, but investors still seemed a little bit on the fence. Then the earnings come out and there's a bit more momentum. What do you see happening specifically with this company before we talk more broadly about the mood around tech?
Yeah, good morning, John. We on Alphabet have done for several years. It's actually been a pretty poor performer year to date. And why is that? It's the big worry that large language models, your chat GPTs, etc., are going to eat the search business. And we see continued, again today, continued growth in search, double digit. Also, if you drill down into what Alphabet is, you look at YouTube, you look at their cloud business, those businesses are powering ahead. And the search category which large language models might attack, well, maybe it's only about 25% of revenues, maybe a bit bigger in terms of profits. And they have, through Gemini and their own products, are really starting to push quite hard into that. So they will lose market share in search. I think today investors are realizing there's a lot more to Alphabet, and perhaps that market share loss in search will not be as great as they previously feared.
And I had a conversation last hour with a strategist who feels like the momentum to the so-called Magnificent Seven stocks, based on what we see as we roll through earnings season, could be a real theme to watch. How do you feel about how the technology companies that are already sporting big valuations, but really there was a little bit less talk about those so-called stocks for a period of time this year. How do you feel about how the market will position itself in the next few months?
Yeah, in the short term, the market follows the narrative, and the narrative for these stocks, maybe I guess Tesla would be excluded from that, but the likes of Microsoft, Amazon, Meta, Alphabet, which we all own, continues to be very positive in terms of what they're delivering as businesses. But you're absolutely right, valuations are up there, are stretched to some extent. So whilst markets may continue to favour them, the popularity contest continues. I'd be a little bit concerned about aggregate position sizing in some of those names.
Okay, you referenced Tesla, so let's get into the Tesla story as well. So many moving parts with the company. I think, at the end of the day, it's difficult to just look at the quarterly results and make a determination on the business itself. This seems to be Elon Musk reminding people that with, EV incentives drying up in the U.S., he's bracing people for some challenges ahead. So what do you think about with a company like Tesla by comparison?
Yeah, let's just step back. Tesla has a market cap today, I think just below 1 trillion now, given today's sell-off. But they have about 100 billion of sales, and most of that comes from the auto side. They have a solar business as well. A good mass market car manufacturing business would make between 5 and 10% operating margins. Tesla's in there, although tax credits on carbon do actually contribute to that, and would be valued around about 1x sales. So you look at Volkswagen, BMW, Toyota, let's call it 1x sales. Let's be really, really positive on Tesla and value the car business at 2x sales. I wouldn't like to do that, but let's do it. Then you have a market cap of the rump of 800 billion. And what are you getting for that? You're getting, driverless taxis, driverless cars, robo-taxis, humanoid robots, power storage. There's a few irons in the fire, a few moonshots, as you might say, if you use a kind of technology term. I just don't buy that. Is it possible that Tesla can derive the sort of revenues and profitability that could justify that rump valuation of 800, 900 billion, which isn't the car business? I just don't think it's highly likely. I think it's very unlikely. So all the noise regarding the cars, politics, his involvement obviously with the Trump administration, etc., people boycotting, Teslas both here in the US and in Europe, it doesn't really matter. You are paying a whopping great price for a lot of hope, a lot of science fiction, and I would prefer not to do that.
Okay, and just jumping back into politics for a second here, because there's not a lot of dull moments, because the because the takeaway from the quarter had a lot to do with, in the short term, what the incentive picture looks like. I should point out to our audience that U.S. President Donald Trump has posted on his Truth Social platform today, quote, "Everyone is stating I will destroy Elon's companies by taking away some, if not all, of the large-scale subsidies he receives from the U.S. government. That is not so. I want Elon to thrive like never before. The better companies do, the better the USA does. That's good for all of us." So we will leave it at that. I do want to talk more about, though, in this kind of environment, you've mentioned you've had some positions in other technology companies, but in terms of where you see value in a market that is at the surface trading at all-time highs, if we were to think about the Canadian stock market first, would there be an example of a company that you look at right now and you think, okay, that looks like a good opportunity to put money to work?
Yeah, where we've been putting money to work in Canada recently is quite varied. There's no obvious sector that really jumps out and saying this is overlooked, there's lots of bargains here. It's really, stock by stock basis. And I love nothing better than buying a great quality company that's on sale for what we believe, or we hope, is short-term factors. So in Canada, we recently were buying, both of the Caterpillar dealerships, so Toromont and Finning. Just overlooked stocks we think look well positioned for long-term growth. Obviously, there's some cyclical pressures on those businesses, but ultimately they will come through that. We were buying, Canadian natural resources. Energy is a sector that no one really talks about anymore. Yes, we focus on the oil price in the short term, but their break-evens are way down below $40 WTI, and we like that. So there's a number of individual companies trying to find great businesses that for some short-term reason are overlooked, or there's something that we think is just misplaced in terms of investor sentiment.
And then one name that you mentioned to our production team about, Alimentation Couche-Tard, which is generally a well-liked company. They were trying to buy the parent company of 7-Eleven. They walked away from that. People actually responded very well to that. How do you think about that business right now?
Well, firstly, to say you pronounce it much better than I can.
I have to.
We were long-term shareholders of Couche-Tard. I won't try and pronounce the first part of it. And we sold after they made the approach to Seven & i. We just didn't like the size of the deal. They'd previously made an approach to Carrefour, and so we were really concerned that they were trying to do some sort of legacy deal that was just far too big, with far too much debt and far too much risk. So we stepped out of the stock, but we still liked the business if they would stick to their knitting of doing small bolt-on, roll-up acquisitions. Here we're back. The deal is off the table. We bought back into the stock quite recently. We like the business. They're facing some short-term cyclical pressures, particularly in the US, but there's still great opportunity, a great long runway for growth, for a well-managed roll-up strategy, and a reasonably attractive valuation.
And then a final one I wanted to flag, Starbucks, which interestingly, today we're seeing a sizable sell-off in Chipotle, which is where Starbucks' CEO used to run Chipotle and ran it quite well. Starbucks had faced plenty of investor pressure. What is it about the business that gets your attention?
Yeah, it goes back to the point of, can we find great businesses that are trading on attractive valuations for reasons that we believe will be temporary or short-lived? And Starbucks has, a couple of real issues. One is just, it's kind of lost the Starbucks, culture's the wrong word, but alienated its customers here in North America. And then you have China, which used to be almost 15% of the business, is now less than 10%. New management, of which I put some stock in, are just going to get back to Starbucks is the slogan they're using. So let's get back to what Starbucks is all about in its core offering, and getting rid of some of the menu items, making the service and the customer, feel just so much better, and then probably doing something strategically with China. They may sell that business or JV it to some extent, but it's still Starbucks. It's still a place that I would argue is almost non-discretionary in terms of spending. Their profitability is depressed. Their sales are under pressure. I fully believe in 2 or 3 years' time, we'll be sitting here, Starbucks will have righted the ship, the sales growth will be back on track, profitability will have recovered, and you'll have a fairly cheap stock on your hands.
All right.